This recording, we're now going to look at the other key standard we're focusing on for week 3, which is IAS 41, a relatively short standard focused on the area of agriculture and agricultural output. So the whole idea of 41 was to establish a standard for accounting for agricultural activity. Now this is an important thing. It's about the management of biological transformation. So what we mean by this, think about biological assets that they actually grow and mature. So you think of cattle, you think of sheep, you think of vineyards with grapes, etc. They actually grow biological assets and they harvest the products then. So we have to have some way accounting for that in terms of the actual physical change that happens over the lifetime of this particular biological asset. That doesn't happen when you have property, plant and equipment. When you buy it, it stays the same, and it stays the same each year as well, allowing for depreciation. So we needed some different standard, not IAS 16, not IAS 40, to deal with this particular type of asset. Right? So they cannot really be measured using concept of IAS 16 and IAS 2. The question is, number one, when should a biological asset or produce be recognized? So when it grows, when it was born, etc. So how do you recognize, for example, a tree if you own a forest? Because the tree grows each year and its value changes, its physical nature changes, and therefore its value changes. Same with a vineyard, right? Same with animal production, for example, in farm activity. At what value should we recognize the biological asset or agricultural produce to be measured? Because remember, some of these won't technically cost anything, right? For example, if you're breeding new animals, right, you're not buying the animal is born on the farm and it's growing in the farm. So how do we assign a value to something that didn't cost anything? We need some rules, consistent rules for that. And finally, how should the differences in the value of a recognized biological asset or produce between 2 year ends be accounted for? So how do we account for the fact that, for example, between 1 year and the next, an animal has grown a year? So physically it's a year older, that means a year bigger, but also the price of the animal might have changed in the intervening period as well. So we have to distinguish between the differences in values and where they'll come from and provide a reconciliation of that. So it's a bit more complicated when we're talking about living, breathing assets, trees, grapes in a vineyard, wheat, barley, etc., cocoa beans, anything that's growing is under the remit of IAS 41. It doesn't cover land, that's IAS 16. It doesn't cover intangible assets, it's IAS 38. Anything that's once it's harvested, so once you harvest the cocoa beans, once you harvest the forest into timber, once you, for example, shear the sheep and you have the wool, that is now inventory. It's a particular asset, it's no longer growing, and it's going to be part of your inventory, which is covered in IAS 2, which we also covered this week. The other one exception is what we call bearer plants related to agricultural activity. Now, these are essentially used in the production of agricultural produce. So, for example, tea bushes or grapevines, they are the actual plant that bears the fruit. Right? They're not the actual produce itself. So these are accounted for under IAS 16. So they'll costed and then they'll be depreciated over their useful life. Right? And of course, you can use the revaluation model as well. Once you harvest the agricultural produce from them, then you'll be using IAS 2. So the grapes from the grapevine, the tea leaves from the tea bushes. Now it's a bit more nuanced. Don't worry too much about it AC 220. But just remember, we have particular standards for each area within accounting. So it's important to understand IAS 41 is a key standard, and it is an important area that's warranted in terms of its specific rules. Right? So the overview itself is what agricultural activity, it's the management of the biological transformation and harvest of biological assets. Now that's a bit wordy, but essentially think about the biological transformation from a seed to a fully mature tree that's harvested in a forest, right? From the birth of a lamb, the birth of a cow, to when it is used to produce meat, used to produce milk, right? From a seed to a coffee bean, from a seed to a field of wheat, a field of barley. So that process of managing that biological transformation, where it grows, it's born, it grows, and it's harvested, that's agricultural activity. And it needs its own set of rules. Right? So biological assets, these are the core income producing assets. They're held for their transformational abilities, to grow fruit on trees, right? To give birth to new animals, to produce milk, to produce wool, right? To produce grapes from a tree. That biological transformation includes growth, degeneration, as for example, plants and animals get older. Procreation, the creation of new animals and new plants. And that means there's quantitative and qualitative changes in the biological asset. The asset changes because it grows or degenerates as it gets older. And it also creates new assets. It produces new, for example, fruit on trees. Animals give birth to new animals that are now going to be part of the business. So it's how we account for all that transformation and we present it in a set of financial statements is what IAS 41 is about. All right. So the scope of IAS 41 is 3 elements. Your biological assets, sheep, cattle, trees in a forest, grapevines, etc., and the produce that come from those biological assets. You get wool from sheep or meat. You get logs or timber from trees. You get milk from dairy cattle. You get meat from beef cattle. You get grapes from the grapevines. So they're different things now. The biological asset itself, that provides agricultural produce when it is harvested. And there's also government grants then related to agricultural activity and how to account for those. So this one, if you want a flag beside it, that will also be under the remit of IAS 20. Government grants in general, but it's linked here to agricultural activity, which is under the remit of IAS 41. Just give you an example of these biological assets and the produce they have. So for example, you can have a sheep, which the produce will be wool, and that can be produced into end products like yarn or carpet. So the key point is there's different stages in the biological process or steps. So for example, here you can have dairy cattle. Their produce is milk, which then can be further processed into cheese. So there's different steps along. We need to know, well, when is it IAS 41? When does it turn into an IAS 2 inventory issue, and then on to finished goods, which are classified under IAS 2. So we need to think about that link between IAS 2 and IAS 41. So initial recognition of a biological asset or produce when the entity controls the asset as a result of past events. So you have to control it. You must be probable you're going to get money from it or economic benefits, and you can measure it reliably. Fair value or cost. Now that's like any asset, like IAS 16 definitions as well. You must control it, must be probable you get future economic benefits, and the fair value or cost must be measured reliably. It's a standard kind of required definition from an asset in accounting frameworks. Right? How you measure them, biological assets at recognition and at the end of each reporting period are measured at fair value less cost to sell. So that's important now. They're not measured at cost, nor at recognition or at end of each period. You're always measuring at the fair value less cost to sell. Because remember, for some of the assets, like calves, like lambs, like piglets, these are born. There's no cost associated with them. So to get a fair reflection, you measure them at fair value less cost to sell. Agricultural produce then is measured at fair value less cost to sell at the point of harvest. And that fair value less cost to sell becomes, in inverted commas, the cost for IAS 2. So the point of harvest here is the transition point. When the wool is taken off the sheep's back and created into wool, then it becomes from IAS 41 to IAS 2. When the grapes are taken off the trees, then they become IAS 2. And the deemed cost of those grapes or that wool or that cow's milk is the fair value less cost to sell at the date of harvest. And you then apply IAS 2 requirements thereafter. So there is an important link, and the transition period is the point in time, is the point of harvest. That's important that you understand exactly that transition, because you could be asked for that accounting in an exam question. All right. So the fair value is the price that we receive to sell the asset. There's a standard for fair value accounting. It's IFRS 13. Right. The costs are any of those incremental costs. So the definition itself is quite straightforward. You get a fair value, and you're probably going to have to go to experts in the real life if you're trying to get the fair value of, for example, grapes, the fair value of wheat, the fair value of milk. In an exam question, it'll be given to you. In the real world, you're probably going to have to go to experts in that particular industry or sector to figure out what the going market price is for the particular agricultural produce that you have. And any change in the fair value less cost to sell goes to the P&L. So if the fair value goes up each year, then it will be debit the asset, credit the profit or loss statement, i.e. gain. If the fair value goes down, then it will be credit the asset, reduce it, and debit the profit or loss account. A debit to the P&L is an expense. It's a loss in the fair value movement. So those agricultural produce then would be milk, wood, timber, etc., sold by the farmer in the ordinary course of business. So that becomes inventory. And the initial carrying value at inventory is the fair value less cost to sell at the point of harvest. That becomes, as I said before, the deemed cost. And then you apply IAS 2 rules. So from there on, you'll be looking to see, well, is it the lower of cost and net realizable value once it becomes inventory? Right? In certain circumstances, it may not be able to measure the fair value. So you might have a very niche or unique agricultural asset or biological asset where market prices may not be available and you may not have any other approach to determine the fair value. In that case, you can measure it at cost, but this is an exception to the rule. The rule is measured at fair value. If fair value isn't available, then you can measure the cost, but that must be disclosed in the financial statements that you've taken that particular choice. So the general rule is you must measure it at its fair value, less cost to sell, unless there's an exception. The other key small thing before we go through an example is government grants. Now, a lot of farms or agricultural businesses will get grants off the EU, off the Department of Agriculture and the Marines. So what we're looking at here then is, well, what are the requirements in terms of accounting for those grants? The IAS 20 is still relevant, and we'll cover this later on semester in terms of government grants and how to account for them. If the biological assets are measured at cost, you use IAS 20. Now remember, that is the exception. Most biological assets are measured at fair value less cost to sell. And if that's the case, IAS 41 sets the rules. An unconditional grant, where you're getting it without any conditions, is recognized in the profit or loss statement. If it's a conditional grant, which means you're only getting the grant based on certain conditions being met, you only recognize the grant in the P&L when the conditions are met. So it's essentially a binary, it's a either or outcome. Either you get an unconditional grant, you recognize it straight away, or if you get a conditional grant, you recognize it when those conditions are met. That is for most government grants related to biological assets. If the biological asset, by exception, is measured using cost, then you go back to IAS 20. And we will deal with the rules of IAS 20 later on in semester in about 2 or 3 weeks' time. So what we're going to do now, because there's a lot of narrative there and it can be tricky to actually engage and understand exactly what we mean, we're going to look at two examples. An illustrative example, for example, of a herd of dairy cattle. And what you're asked here is provide a reconciliation between the fair value of the herd on the 1st of January 19 and the 31st of December, as required by IAS 41. So one of the key disclosure requirements in IAS 41 is explain how you got from the fair value, opening fair value, at the 1st of January, so we say 1 Jan 19, to the closing fair value on the 31st December 19. And what they want you to split between is the change in value because of physical change, i.e. being 1 year older, or the change in value because of price changes, because the price of calves, the price of 3-year-olds has gone up or down in the intervening period. So they want that reconciliation and the reason, the changes between the opening and closing fair value. So if we start on the 1st of January, this dairy herd consisted of 100 2-year-old cows and 50 newborn calves. So in value terms, it was 100 2-year-old cows, which are worth 70 each, 100 times 70, plus 50 newborn calves, which were worth 50 each on the 1st of January 2019. So the fair value of the relevant biological assets, which are the animals, the cattle, at the 1st of January is 9,500, which is 100 times 70 plus 50 times 50. You're taking the number of cattle that you have and the relevant price they were, the value they were on the 1st of January. It's like a stock count and you put a value on it. You do the same at the year end. During 2019, a further 30 cattle were born. None of the herd have died or were sold. So at the year end then, what do we have? We now have 100, be careful, 3-year-old cows. Why? Because if there were 2-year-olds at the start of the year, they're 3-year-olds now. We have 50 1-year-old. Because the newborn calves on the 1st of January, at the end of the year, will now be 1-year-old. And we have 30 calves were born, So you're going to have 30 calves. Now we assume those calves were still calves at the end of the year. They haven't been the full year, so we just classified them as calves. So their value then is 100. Be careful, at the end of the year, these 100 are now worth 80 because they've gone from 70 as a 2-year-old to 80 as a 3-year-old. The 51-year-olds are now worth 65, and the 30 calves are now worth 55. So you have to think about their age at the particular point in time. This is a tricky question. So the fair value at the end of December is 100 times 80 plus 50 times 65 plus 30 times 55. All the assets that you have, the biological assets, at the relevant fair value at that date. And that answer is 12,900. So what we have to explain is, how did the opening biological asset of 9.5 increase to 12,900? Right? And split that between physical changes in the herd and price changes. Right? So let's have a look here then. Let's initially look at the physical changes. What physical changes happened? And let's look at the 100 cows, 2 to 3. They went from 2-year-olds to 3-year-olds. So the 100 cows here were valued at 70 at the start of the year. The actual value of 2-year-olds is now gone up to 75 at the end of the year. I know they're now 3-year-olds, but holding constant, even holding a 2-year-old, the price is gone up. And then if you look for 3-year-olds, the price has gone up as well. So if we're looking at the physical change, right, how are you gone from 2-year-old to 3-year-old? Well, the physical change is from a year older, you're worth 80 instead of 75. So for 100 cows at 2-year-old each, I'll bring this over one, it's going to be, in this case, 100 times 80 minus 75. So that, in this case, is 500. Because the cows are now a year older, based on December 2019 prices, they're going to be worth €5 more each because they're a year older, they're 3-year-olds instead of 2-year-olds. Right? In price changes for the 100 cows who were 2-year-olds at the start, so just looking at the price change you went from 100, 75 instead of 70. So you made a 500 gain there as well. So because we had 2-year-old cows, if they physically didn't change, the price of them, the fair value of them went up. It went from 70 to 75. And the fact that they got 1 year older then brought them from 75 to 80. So overall, they've gone from 70 each, up here, to 80 each. But some of that was due to a change in their physical form. Some of that was due to a change in their price. And you have to split that out under IAS 41. Right? That is tricky. Same then for the calves. So the calves go from 0 to 1, the physical change. So 50 calves, right? They're 55 compared to 65. Calves at the end of this year were 55. Because they're a year older, they're now worth 65. So that is an explanation of 500 as well. 50 calves are worth €10 more. Just comparing the year difference, the physical change. The price difference then, the calves, the price change, calves are now worth 55 instead of 50. So solely because the price changes, they're worth more. And that is 250. So that's a tricky one that you can hit your head around that. Where exactly are these things coming from? Right? You have to look at the physical change and you have to also look at the price change. And you have to isolate. It's like variances. You're isolating one or the other. Because we had 2-year-old cows, if they physically didn't change, they'd still be worth €5 more over the 12 months. But because they physically changed as well, they're now worth €10 more. 5 because the price has gone up, another 5 because they're moving from 2 years to 3 years. Now, if you add those together, they don't actually balance. We're only at 11,250. What you have to remember is we have births as well. We have how many new calves? 30 new calves were born. So that is going to be 30 times 55. And that is 1,650. So that explains the increase overall. So when you do that down, you're explaining how you got from 9,500 down to 12,900. Some of them is new births, which you bring in at the end of the year. Some of it is due to physical changes with the existing herd. They're all getting a year older. And some of it is due just down to price changes, that the value of calves, the value of cattle have gone up over the last 12 months. And that reconciliation is required in IAS 41, that you know exactly how to reconcile between the opening balance and the closing balance. Now that is not easy. There's a lot in that that's new, but it's important you go back and look at your question pack so you understand exactly where those figures are coming from. So to recognize that as a debit and credit at the end of the year, you would debit biological assets and you would credit the SOPL, the difference, which here 12.9 minus 9.5, 3.4. So remember, the 9.5 is already in there. All you're doing is increasing or decreasing it. So you're saying I want to take that 9.5 on the 1st of January and increase it by 3,400. So my closing biological assets in my statement of financial position will be 3,400 higher. And what you'll do is you credit that to the P&L. So that goes as a gain in the statement of profit and loss. Right, so hopefully that makes sense. That's a key working under IAS 41. You measure them at fair value and you split out the movement. Right. So let's have a look at the next one. The next one then is dealing with another herd of animals. And you're asked to provide a reconciliation between the fair value on the 1st of January and the 31st of December. So let's take the same layout again. The 1st of Jan 2019 and the 31st of December 2019. Now ideally you'll pause this, try it yourself to see how you get on, and then come back to it again, just to see how you get on. The 1st of January, we had 10 2-year-old animals, and 2-year-olds the 1st of January were worth €100. So it's going to be 10 times 100, €1,000. Nice starting point. That's the only animals we held on the 1st of January. One animal aged 2.5 years was born on the 1st of July for 108, and one animal was born on the 1st of July. No animals were sold during the period. So just think about your herd now. What do we have at the 31st of December? We now have 10 3-year-olds. Because you have 10 2-year-olds at the start of the year, they're now a year older. And those 3-year-olds are worth 120. Right? The one animal we bought at 2.5 years, purchased on the 1st of July, they're actually going to be 3 years as well. One 3-year-old. That's worth 120 as well. So if you said 11 3-year-olds, that's fine. Right, but the one that you bought here at 2.5, you purchased on the 1st of July. That was half a year ago. To bring it to 31st December means another half a year. So they are 3 as well. The animal that was born in July will now be 1 half-year-old, 0.5-year-old. And they are now going to be worth 80. Because if they're born in July, bring it down to December, they're worth 80 as a half-year-old. So subbing those in, you have 10 at 120, plus 1 at 120, plus 1 at 80. So the fair value of the herd at the end of December is 1,400. So we have to try and figure out how do we get from 1,000 at the start of the year to 1,400 at the end of the year. How can we reconcile between that basis? Right? So let's have a look here. And let's see, can we split it out and figure out exactly what's going on. So let's look here at the physical difference or physical changes and then the price changes. Right? So what about the physical changes? Let's take the 10 2-year-olds. Right? Well, the 10 2-year-olds, I'll bring this over a small bit. The 10 2-year-olds physical changes, they're now gone from 2-year-old to 3-year-old. So we're saying price change brings us to 105, and then 105 to 120, because they're a year older, it's worth 15. Right, so you compare the 120 to the 105. So in this case, it is 10 times 120 minus 105. So the difference there is 150. The price change for the 10 2-year-olds is the other part. It's 10 times, because a 2-year-old now, it was worth 100 at the 1st of January, it's now worth 105 at December. 105 versus 100, which is 50. So do you see the way we work it? We know the 2-year-olds are gone from worth 100 each to worth 120 each, but we have to split that. The 100 to the 105 is the price change, how 2-year-olds have moved. The 105 to the 120 is the physical change. What's the difference because these cattle are 1 year older? The same thing we're going to do now for the 2.5-year-old. 2.5-year-old. Right, and we'll do it down here. You have to do the same for the other ones. It's a bit trickier on this one. You bought it for 108. So the physical change is the 120 versus the 111. So here equals 1 times 120 minus 111, which is 9. The price change, 2.5-year-olds is worth 108 in July. It's worth 111 in December. So that's 1 times 111 minus 108, which is 3. Where am I here? 1 times 111 minus 108, which is 3. I'd say your key differences so far. And you have to do the same with the animal that was born in July. So the animal that was born in July, in terms of the price difference, so the newborn, the calf, that calf, the physical change is gone. It's now a half-year-old, so it's 1 times 80 minus 72, which is 8. And the newborn here, physical, or the price change is gone. Calves are now worth €2 more. So even if that calf didn't change age, it'd be worth 72 compared to the 70, which is €2 more. Right, now that is tricky. Getting all those different elements in is quite tricky. But if you look at here and we add these up, that only gets me to 1,222 by only recognizing the physical changes and the price changes. What you have to make sure you bring in as well is the birth, because we haven't actually recognized a calf was born in July, worth 70, and we haven't actually recognized the purchase, which was bought during the year, which was 108. So don't forget to recognize the actual transactions. We recognize the movements from 70 upwards and from 108 upwards up to 120, but we actually haven't recognized that this birth increased the value, as did the purchase of a 2.5-year-old cow animal during the year as well. And when you tot those up now, the sum comes to 1,400. So not alone do you have to watch for the physical and price changes, you need to watch out for any particular acquisition during the year as well. So let's have a look now. What would the debits and credits be to finish off this example? This is where you have to be careful. We are debiting the biological asset, 400. That's clear, because the asset has gone from 1,000 up to 1,400. So you increase the value of the asset by debiting it. Be careful now, you're crediting bank 108. Why am I crediting bank? Because remember, you bought one of those assets. One of the reasons this biological asset goes up wasn't because there was a fair value movement, it's because you physically bought this. That was purchased, so it must be credit bank. The rest then is credit SOPL, the difference which is 292. So be careful with that. When you have any acquisitions, births, they're like a fair value movement. They can be treated as such. But for purchases of assets, that has to go through bank, because you would have paid for that asset using your checkbook or using bank, which is credit 108. The previous example, we didn't have that. we only had any movements during the year or new births. There was no actual acquisition. Whereas in this one, we have an acquisition, which must be through credit bank. So just be careful of that if you are asked for journal entries to be able to slot it in. Right? So make sure they're tricky numerical examples, but I want to make sure you go back to the question pack, which is associated with IAS 2 and with IAS 41 as well. At the back of that question pack, there are questions dealing with IAS 41, particularly giving you another couple of practice around the reconciliations and also the debits and credits associated with IAS 41. So it's important to go back over those two examples now and make sure you're happy with the computational aspects and the debits and credits of IAS 41. So here, IAS 41 and FRS 102, there's not a huge amount of difference in terms of IFRS, international standards, versus UK and Irish GAAP. But both require reconciliation, the two examples you've just gone through. But IAS 41 does include a requirement in relation to exchange differences. So if you have FX differences dealing with fair values in different currencies, which is not required under FRS 102. But as I said, that's probably a bit beyond the scope of AC 220, so I wouldn't concern myself too much. The overall thing is they're very similar requirements. From a disclosure perspective, they expect you to show the aggregate gain or loss on the initial recognition, a description of the biological assets, and the nature of the entity's activities. So where are these IAS 41 assets coming from? And particularly the main one here is the reconciliation between changes in carrying values, showing separately changes in value, price changes, changes in purchases, sales, harvesting changes, etc. So that reconciliation is one of the key disclosure requirements in IAS 41, where you show how you got from an opening fair value to a closing. And that's the one that you need to focus on in your examples. And particularly in terms of textbooks, the likes of Elliott and Connolly, have a quick read of both of those chapters. If you are, because this is quite a tricky area, that's why I've given you some extra reading around it. It's not the biggest area. It's certainly not on every exam paper. You're probably talking maybe once every 2 or 3 papers you might see IAS 41 come in. But it is an important one that you realize it's still on the syllabus. It is still an international accounting standard that's active, the companies still have to abide by. And there's a couple of questions in question pack 8 that you can have a look at to finish that off as well. Right, so that recording then looked at IAS 41, focused on agricultural and biological assets.